Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA N Raja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executives. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar.
This is going to be an interesting video because I got this question many times. I answered one-to-one. Since it was asked by many, I thought it will be more relevant if I create a video out of it. Okay, so what is the question? Why interest on working capital is not factored in DSCR calculation? Yes, many get puzzled with this. In DSCR calculation, we are taking interest on term loan. Why we are not considering interest on working capital? Why? See, first of all, why do we calculate DSCR? Debt service coverage ratio. Why? We calculate debt service coverage ratio to measure the repayment capacity. Okay. Repayment capacity. Repayment capacity for what? Repayment capacity for repaying the term loan. We are not calculating DSCR ratio to measure repayment capacity for repaying working capital. No. We are not calculating DSCR for measuring repayment capacity of cash credit. No. We are arriving at DSCR basically to measure repayment capacity only for term loans. Okay, have that clarity in mind. Number one. What is the formula? The numerator of the formula says cash profit available for servicing the term loan, okay, and denominator says term loan annual obligations. So if I expand this formula, you will get it like this. Cash profit available for term loan is arrived as profit after tax added by depreciation and added by interest on term loan, and if there are any dividend payments expected, that will be subtracted, that we see rarely. Okay, this is going to be the numerator, and the denominator will be annual interest plus principal. And it is here many are getting puzzled. Why interest on CC is not added here in the numerator, and why interest on CC is not considered in the denominator? Why such a partiality? Why you are ignoring interest on CC? There is a general understanding interest on CC will get captured in cash cycle, in cash flows. See how the cash cycle or cash flow happens. Borrower will have cash. He will invest that in raw material, which will go to production. Then it will become finished goods. Then it will be sold to customers' debtors. Then eventually this cash will come. And all these are going to happen in the cash credit account, right? All these are going to happen in cash credit. So all inflows, all outflows are going to happen, and it will automatically adjust or take care of interest on CC as long as things are positive and healthy. Okay, but if there is going to be only cash outflow, and if there are poor cash inflows or nil cash inflows, then obviously there is going to be a problem. Okay, but the general understanding is if there is a cash outflow, there is going to be a cash inflow, and that inflow will happen with profit, and that profit will take care of paying interest on cash credit. That is the theoretical understanding. Now let's come to some logical reasons why interest on CC is not brought in the formula. Let me tell you one thing. Do not think interest on cash credit is not factored in DSCR. It is factored. Interest on cash credit is factored very much. I will show you some numbers so you will understand it better. Before that, let's get the clarity once again. DSCR is basically calculated to measure the repayment capacity for term loan only. Repayment capacity means whether the borrower is having capacity to repay the term loan principal, to pay the term loan interest. For this, whether adequate profits are available. That is the only purpose. And when we say profits are available for paying term loan means it should be a profit after meeting all the operational expenses like raw material, labor, other manufacturing expenses. It should be a profit available after meeting non-operational expenses like admin expenses, selling and distribution expenses, and it should be a profit after covering other borrowing costs also like interest on CC, interest on other loans. It means if you look at the numerator of a DSCR, it is profit available for paying term loan, which is paying interest and principal. It means that profit should be available after meeting all the expenses. It means in that place, interest on CC is also considered. Only the profit available after paying interest on CC is considered for measuring the repayment capacity. With this backdrop, let's look at this case study. So look at this scenario. There is a sales 100 million, expenses, raw material, labor, other manufacturing expenses and depreciation. So total expenses are 70, sales is 100. That gives profit before tax of 100 minus 70, which is 30. Now this is profit before interest. So interest have to be paid. Let's assume interest on working capital is 5 million, interest on term loan is 10 million. So 30 minus 15, you get profit before tax of 15 million. Then there is a tax of 5. So this is profit after tax. We have to calculate DSCR if principal repayment is 20. Okay, let's do. We know the formula for DSCR, which is cash profit available for servicing the loan divided by term loan obligations. And cash profit available for servicing the term loan is nothing but profit after tax plus depreciation plus interest on term loan only, because profit after tax is itself arrived after subtracting interest on working capital. Okay, so let's take what is the profit after tax, which is this 10. So we will bring the 10 over here. Okay, then what is depreciation? Depreciation is this 15. We will bring that here. Then we have interest on term loan, which is this 10. Will bring out here. So this numerator is this one, 10 plus 15 plus 10. What is the denominator? Is annual interest that already we have written in the numerator, which is 10. We'll bring that over to denominator also. Then annual principal, this is something given as an additional information in this case if principal repayment is 20. So we'll write that also here. So numerator is 10 plus 15 plus 10, 35. Denominator is 10 plus 20, which is 30. And if you calculate DSCR now, it is 35 by 30, 1.17 times. Now, let me step into the shoes of those who ask this question. Why you are not including interest on working capital in the numerator and denominator? Okay, let me include and let's see what happens. So this 10 is profit after tax, 15 is depreciation, interest on term loan is 10. Now, since you wanted this interest on working capital to be considered, let me bring this 5 and add it here in the numerator. What is the idea behind adding interest in the numerator? It is to know what is the profit before paying that interest so that you can use that and compare it with the obligation, right? So in the numerator, I have added this 5. Now, since I have added this 5 in the numerator, what I should do? In the denominator also, I should add that 5 and I should consider its principal also, right? So if this 5 is interest on CC, right? This 5 is interest on CC, then I should also bring its corresponding principal in the denominator, but cash credit is annually renewable. I'm not going to pay it in the current year. So it is not going to appear in the denominator because there is no compulsion to repay. So what will happen? I will just add one number in the numerator. I will divide the same number in the denominator. Just by adding 5 in the numerator and repeating that 5 in the denominator, what will happen to my ratio? This 35 will become 40 and 30 in the denominator will become 35. 40 by 35. You will get the ratio as 1.14, which is lesser than what we have originally calculated. Fine. But the question is, what we are trying to measure through DSCR. DSCR is basically calculated for term loan. If your organization insists DSCR to be calculated for working capital also, which most of the organization will not, then you can do this approach. Otherwise, this exercise is not at all required, because here the focus is on measuring the repayment capacity for the term loans and not for working capital.
Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you.
It is this Credit and Financial Analysis Mastery course, exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course, you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you, it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over. You also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course, you will understand what is working capital, what are working capital credit facilities, and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2499, lifetime access rupees 4999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course, you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis, various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about collateral securities, where you get knowledge about collateral securities. So overall, it's 15 courses of value close to 22,485. It's 1000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description where without using any discount coupon code you can enroll at this discounted price because it's a discount applied link. And not yet over, you're also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.